A 22-year high of interest rates and a 40-year high of inflation just went through the U.S. economy and our current market. And yesterday, the Feds had their monthly meeting, and the news was better than expected. Investors, real estate professionals, listen up. This is what we've been waiting for. Now, lo and behold, we weren't expecting it quite this early, so any good news that comes early is something to embrace. We were expecting interest rates to go down in 2024, but we weren't expecting the announcement that we got yesterday, which is a better ploy to investors to start taking action than the contrary. And so right now, let's do a recap of yesterday's meeting and what this actually entails and how this actually is going to affect the market potentially and what this means for you, for end buyers, investors, and real estate professionals. So one of the big things that happened yesterday is that the Federal Reserve stated that they're anticipating 3 reductions in increments of approximately 0.25 percentage point reductions of the federal funds rate. So we're expecting 0.75% reduction. But then Jerome Powell came out and said he wants to pencil a minimum of 1.5% point cuts next year. So ladies and gentlemen, what that means is that interest rates are going to start softening, and we should start seeing them soften by the first quarter of 2024. Now, for those of you guys that are looking at value add real estate, or for those of you guys that are looking at ground up construction, listen up, because I'm going to explain to you guys what this means for you guys before I go into some of the other projections as we move into 2025. Because if we start in this direction, my biggest concern was, okay, are they going to go down? But will they go back up? And the reason I'm concerned about that is because right now we do a lot of ground up construction. And because we do a lot of ground up construction, I want to make sure that if I turn dirt on a project, that I don't get a great interest rate on my construction loan. And then when I go to my stabilized loan, the market has changed yet again, and now I'm paying inflated rates. So I was pleasantly surprised to hear that the projections for 2025 was for 4 additional reductions in basis points of the federal funds rate and another 3 projected in 2026. And so what analysts are looking at right now is they're looking at a federal funds rate of by 2026 of between 2% to 2.5% federal funds rate, which means that lenders will be lending money anywhere between 4 and 5% on stabilized commercial loans. And so that's a big grace on values and for syndicators and asset managers. And one of the biggest reasons, because one of the things that I talk about is I tell people, as interest rates go up, cap rates have to run in parallel to interest rates. If they don't, you can't afford the debt on that asset. Now, if you have a locked-in long-term rate, then that asset can continue running at the cap rate it once did. So the only people that lose are the ones that have to sell or have to refinance under a market contraction. So I always tell people, sometimes it's better to pay a slightly higher interest rate to get a fixed rate mortgage, especially if you're going to keep that asset long-term. And even if you want to protect your investors as an asset manager, and you want to really make sure that that asset is going to hold its stabilization over the course of time, when interest rates seem to be going down and they feel like they're going to hold forever, one thing that we've learned over this cycle is that the unexpected should be expected. And I've always told people that when things look too good from the outside looking in, they typically are, and you have to always invest with caution and a worst-case scenario to protect not only yourself, but if you're raising capital, your investors. Because at the end of the day, your reputation and their financial well-being depends on good decision-making by you. And so, although the rate reduction is less than the market had been pricing, it is a lot more aggressive than what officials have originally indicated. So we're pleasantly surprised to hear what the Feds have actually proposed. And actually, even more so, pleasantly surprised to hear what Jerome Powell has to say in his goal for 2024 year. Now, one thing that I've been talking about, ladies and gentlemen, and it clearly states in the CNBC follow-up, and it also states in the Fox News follow-up, if you guys go and read the follow-ups that Fox News and CNBC wrote, is that the Feds are conscious of the election year. And because Joe Biden has gone a wrath for how the economy has actually went over the course of the last 4 years, it has dramatically decreased his popularity in the market, rightfully so. And so what I always tell people, it doesn't matter what party, whether it's Republican or Democratic, it doesn't matter what party it is, anytime there's an election year, historically, the Feds run to try to push rates down to make whoever the president is look like a superhero, especially on a 4-year term. So we had been predicting that 2024 was going to be this recovery year, and lo and behold, the Feds confirmed it yesterday, so we're really extremely pleased with that. Now, let's take a look at what this looks like for the future. So we talked about the federal funds rate being at 2.22% to 2.5% by 2026. But how does inflation look? And is this really going to hold long term? And is inflation going to continue going up? And that's the big question. Because if inflation continues going up and they've wrapped up the American people, so if the Feds were telling us that interest rates were going up to be able to protect us against additional inflation, we were at a 40-year high, what happens if inflation continues to go up? Well, here's what the Feds talked about yesterday. And so pleasantly enough, inflation looks really good. In fact, right now, inflation has fallen 3.2% year to date in 2023. And analysts are projecting that inflation will fall another 2.4% in 2024 and projected to fall 2.2% in 2025, putting us back to historical averages of 2% or less inflation hikes over the course of time. So if projections hold and inflation actually goes down over the next 3 years, and then we slowly start to graduate into inflationary numbers that are healthier and more normal for our economy, the economy can grow at a more healthy rate, and we'll see how over the course of time this truly sustains, and if this holds true to what the analysts and the Fed's projections really are long term. So all of this, ladies and gentlemen, has happened, and what's been ironic out of all of this is unemployment rates. Traditionally, when we go into a market recession where interest rates go up so aggressively and where inflation goes up so aggressively, merchants and end users feel it so dramatically that it affects unemployment. And one of the things that we have not felt over the course of these interest rate hikes and in spite of inflation is a massive increase of unemployment. Unemployment is still just over 3%, and anything under 6% brings a healthy workforce to the United States. So our workforce has stayed extremely stable, extremely healthy, in spite of everything else that's happened economically over the last couple years. So look, ladies and gentlemen, what does this mean for the future? Well, this means that job security will probably continue. And this means that employers, you're probably still going to have an outreach that's more aggressive to find good employees and people willing to work. Because as long as unemployment stays low, the reach for new employees is limited. And so hang on to your employees, make sure you're treating them correctly, make sure you're paying them correctly, and advocate for your company, because it doesn't look like unemployment's going to get affected in a negative way anytime soon. And so with Fed rates going down, I'm super excited because this means that our ground-up construction is going to become a lot more aggressively palatable to multiple lenders and attractive to some of the lenders that we've already did an outreach to. So hopefully HUD rates, Fannie Mae and Freddie Mac rates continue to be complementary and reductions in interest rates even on government-assisted loans in addition to traditional and conventional lenders. Ladies and gentlemen, 2024 is going to be an incredible year. Unfortunately, for those of you guys who sat back over the last 2 years and took a siesta as the market continued to get beat up, may have lost your opportunities to buy in this market. Does this mean that the recession is completely over and that everything has healed itself? No. There is still opportunity on the forefront of the commercial market sector, and it's going to take at least 2 years to financially repair itself completely. So opportunity is still at the fingertips for those that dare, those that educate, and those that embrace. Ladies and gentlemen, if you want more market updates and content just like this, click and subscribe to our YouTube channel. and give us some loves. Pound that thumbs up button. And ladies and gentlemen, I'm going to recommend some other market updates and how you can invest your capital on a few other videos here on YouTube. Ladies and gentlemen, continue compounding your success, and let's go crush 2024.